Follow market projects Google to be the biggest company by the end of this year. But Google also just made the biggest bet in corporate history. On Wednesday last week, Alphabet announced its plan to spend up to $185 billion this year on AI infrastructures. To put that number in perspective, that is more than Google spent in the previous 3 years combined. It is more than the entire market capitalization of most Fortune 500 companies. It is nearly double what they spent last year. And the market reaction, the stock dropped 6%. So what's going on here? Why is a company posting record profit being punished by investors? And what does this tell us where the AI race is actually heading? Let us start with what Google actually reported, because the numbers are generally staggering. Fourth quarter revenue came in at $113.8 billion, beating Wall Street expectation. Net income hit $34.5 billion, up 30% from the year before. For the full year, Alphabet crossed $400 billion in revenue for the first time in the history and made $132 billion in profit. The standout was Google Cloud. Revenue surged 48% to $17.7 billion, the fastest growth rate in over 4 years. For the first time in years, Google Cloud actually outpaced Microsoft Azure. The cloud backlog, meaning future contract orders, jumped to $240 billion. CEO Sundar Pichai said that the numbers of deals worth over $1 billion in 2025 surpassed the previous 3 years combined. Even the core search and advertising business, the one everyone said was under threat from ChatGPT, grew 17% to $63.1 billion. Pichai said he has seen no evidence of cannibalization from rival AI chatbots yet. So by any normal measure, this was a blowout quarter. Record revenue, record profit, record cloud growth, and yet the stock cratered. The reason is the capex number. Google told the investor it expects to spend between $175 billion and $185 billion in 2026. Wall Street was expecting around $116 billion. Google came in 55% above that. In the fourth quarter alone, capital expenditure nearly doubled year over year to $27.9 billion. So where is all this money going? About 60% is being poured into servers, specifically high-end GPUs and Google's own custom chip called Tensor Processing Units, or TPUs. The remaining 40% goes to data centers, networking equipment, and any energy infrastructures. In December, Google acquired a company called Intersect for $4.75 billion to help manage power supply for its AI operation. Google has been building its own TPUs for decades now. The latest generation, called Ironwood, delivered 10 times the performance of its predecessors. It has 192 gigabytes of high bandwidth memory and can process data at 7.37 terabytes per second. This is a chip that will train Gemini for Google's next flagship AI model, expected later this year. The strategic logic here is straightforward. By building its own chips, Google reduces its dependence on NVIDIA and creates a cost advantage that competitors relying on third-party hardware simply cannot match. Broadcom helps manufacture these CPUs and their stock rose on the news. But here's the thing that is keeping the CEO up at night. Even with $185 billion in spending, he expects Google to remain a supply constraint throughout 2026. The demand from Google DeepMind's entire customer, he said, is exceptionally strong. Infrastructure, so not customer interest, but the actual infrastructure is the bottleneck, and Google is not alone in this arms race. Amazon announced on Thursday that it plans to spend $200 billion this year, the largest figure by any company. Microsoft is on track for around $145 billion. Meta has guided for $115 billion to $135 billion. Add it all up, and the four big tech hyperscalers are set to spend approximately $650 billion in 2026 on AI infrastructures alone. That's a 60 to 74% increase from $381 billion they spent last year. Bloomberg called it a boom without parallel this history. To find a comparison, you have to go to the dot-com bubble of the 1990s, or perhaps the build-out of the American railroad network in the 19th century. So why are investors so nervous? The concern is simple. Return on investments are still unclear. These companies are spending at a pace that is consuming nearly all of their operating cash flow. Amazon is projected to go negative on free cash flow this year, potentially by as much as $28 billion according to Bank of America. Amazon even filed with the SEC saying it may need to raise equity and debt to fund the build-out. Meta's free cash flow could drop by nearly 90%. Google was in a somewhat better position. Free cash flow in the fourth quarter hit $24.5 billion, up from $14.3 billion from the year before. but the sheer scale of spending is still raising eyebrows. The software sector has, as a whole, lost 30% of its value in the last 3 months. Microsoft fell more than 10% after its own capex announcement. Investors are asking a fair question: when does all this spending start paying off? The Chai's answer is that the risk of underinvesting is far greater than the risk of overinvesting. Google believe this is a winner-take-all market. If you do not build the infrastructure now, you lose the race entirely. And there are signs that the bet is working. Products built on Google generative AI models grew nearly 400% year over year. The Gemini app now has 750 million active users. Google and Apple announced a partnership where Google's AI will power Siri. The cloud backlog for 240 billion represents real contracted demand, so not a speculation-based hypothetical. But the future is far from certain. Google faces an antitrust appeal from the Department of Justice seeking to force a divestiture of Chrome. The EU's AI Act is creating regulatory headaches. A global memory chip shortage is adding pressure across the industry, and the fundamental question remains: is this the next great technological transformation, or is it a bubble waiting to burst? In my opinion, it's just the next great technological transformation. But what we do know is this: Google has decided that hesitation is not an option. They are spending more in a single year than most countries produce in GDP. They are betting the company on AI. Whether that pays off or whether we look back on this as a peak of speculative mania is something only time will tell.